Imagine this. It's Christmas Eve. Most of us are with our families, maybe watching a movie or already tucked in bed. But deep in the shadows of the global financial system, something big is happening. We're going to pull back the curtain on what our source material calls a secret, unrecorded meeting, a meeting that could change everything for the silver market. What's so striking here is the timing. This wasn't some scheduled board meeting. We're talking 1:30 in the morning. The source claims that's when a secret call began, a call that would shape the future of a key global asset, while the rest of us were completely oblivious, wrapped up in the holidays. While we were celebrating, a select few were deep in secret negotiations. Okay, let's look at the timeline here. The call starts at 1:34 a.m. and ends exactly 47 minutes later at 2:21 a.m. Now, according to the source, there were no official minutes taken, no press release sent out, nothing. Just a verbal agreement among some of the most powerful people in finance. It's that complete lack of a paper trail that makes this whole thing so fascinating. So, who exactly was on this call? We'll take a look. We're not talking about small-time players. You've got banking giants like JPMorgan and HSBC. You have the CME Group, the folks who run the futures exchange. The US Treasury was there, and so was the Bank for International Settlements. A lot of people call it the central bank for all the other central banks. Plus the London Bullion Market Association. I mean, these are the institutions that pull the levers of the global precious metals market. So what on earth could bring all these heavy hitters together for an emergency call in the middle of the night? The source says it all comes down to one single number, $75. We really need to dig into why this specific price for an ounce of silver could be so terrifying that it would shake the entire financial system to its core. Right, so here's the bottom line. $75 isn't just a number on a screen. It's described as the ultimate tipping point. It's the price where the fantasy world of paper contracts, the ones just created on a computer, slams right into the brick wall of real, physical silver that you can actually hold in your hand. And when that happens, the computer models, they always lose. To really get a sense of just how big this problem is, look at this number. There are financial contracts out there, call options, that represent 205 million ounces of silver. And all of them were sold based on the bet that the price would never hit $75. For the big banks that sold them, it must have felt like free money, just collecting payments on something they thought was an impossibility. And here's the collision point. This is where you see the huge gap between what's been promised and what's actually real. While the banks have made paper promises for 205 million ounces, the May marketplace, the COMEX exchange, only has about 24.8 million ounces of actual physical silver in its vaults ready to be delivered. Think about that. That's a potential demand for over 8 times more silver than what actually exists in the warehouse. And this brings us to the core of the issue. You see, there are really two different silver markets operating at the same time. You've got the paper market, and then you have the physical market. They're supposed to be tied together, but as we're about to see, that connection is being stretched to its breaking point.
It's actually pretty simple when you break it down. Paper silver is just a promise, a symbol you can create with a click of a mouse. It's practically infinite. Physical silver, on the other hand, is a real metal. You have to dig it out of the ground, refine it, and ship it. There's only so much of it. The whole system only works as long as not too many people show up at once asking to swap their paper promises for the real thing. Now, this right here is what keeps the bankers up at night. It's called a hedging death spiral. See, as the price gets closer and closer to that $75 trigger point, the bank's own computer programs, their risk management algorithms, automatically start buying silver to cover their massive bets. But here's the catch. That buying action itself pushes the price even higher, which then forces the computers to buy even more. It becomes this vicious, unstoppable feedback loop that could send the price into the stratosphere. If you like our videos, please like, share, and subscribe to follow us so you won't miss any exciting updates.
So back to that secret Christmas Eve call. What was the big plan? Well, according to the source, these powerful institutions all agreed to work together to create what's being called a price ceiling, a coordinated, behind-the-scenes effort to stop silver from ever touching that critical $75 mark. And the plan they allegedly hatched had 3 parts. First, coordinated selling. As the price gets near, say, $73, they would all dump huge amounts of paper contracts on the market to slam the price back down. Second, they'd put pressure on the big silver funds, the ETFs, to get them to stop buying so much physical metal. And third, a big safety net from the BIS, offering unlimited cash to bail out any bank that gets caught in that death spiral. The strategy here is actually pretty clever and a bit sneaky. It's not just about hammering the price down, it's about making the silver market boring. If you can keep the price stuck, just moving sideways day after day, investors get tired, they get filled with doubt, they get bored, and eventually they sell and go somewhere else. And that, of course, helps take the upward pressure off the price.
But here's the thing. No matter how powerful these players are, the source argues this plan, this price ceiling, is ultimately doomed to fail. Why? Because there are three incredibly powerful, almost unstoppable forces pushing back against it. The first force is the most basic one of all, a real physical shortage of the metal. The world simply uses more silver than it mines every year. It's a fundamental deficit. And like the source says, you can print contracts, but you can't print metal. Trying to hold down the price with paper promises when the physical stuff is disappearing? Well, that's like trying to dam a river with tissue paper. Sooner or later, reality is going to win. The second force is something called arbitrage. It just means that smart money will always find the best deal. Right now, buyers in places like Shanghai are willing to pay a higher price for an ounce of real physical silver than you can get on the Western exchanges like COMEX. So what happens? That price difference acts like a giant vacuum, sucking all the available physical silver out of the West and sending it east, draining the very vaults that are supposed to back up the paper market. And the final force? It's just simple human nature, something economists call the prisoner's dilemma. Sure, all these banks may have agreed to stick together, but every single one of them knows that if a real crisis hits, the first bank to break the deal and start buying silver to save its own skin, that's the one that survives. The last bank to act is the one that goes under. This creates a very shaky alliance where everyone has a huge incentive to be the first one to run for the exit. So this whole incredible story leads us to one final, huge question that's really at the heart of it all. The source material is basically describing an unavoidable showdown. So when a financial system built on a mountain of paper promises finally comes face to face with the hard limits of physical reality, which one wins? That's the billion-dollar question the entire market is now waiting to answer.